Welcome back to The Global Investor, the podcast dedicated to helping you build resilient, globally diversified wealth. I'm your host, Jonathan Smith.
And I'm Ellen Catan, here to break down the complexities of international finance into clear, actionable strategies.
Today, we're tackling what I think is one of the most paralyzing decisions for sophisticated investors, the dollar versus the euro. It often feels like you're forced to choose a winner. But as we'll explore, the real strategy is far more nuanced. Ellen, thanks for joining us.
It's a pleasure, Jonathan. This dilemma, USD or EUR, is definitely where I see a lot of smart investors get stuck. They focus so much on what stock to buy that they forget the fundamental question of what currency they're buying it in. That single choice can often determine whether a good investment turns into a great outcome or a mediocre one.
That's a great point. You frame it beautifully in your work. It's not just an exchange rate choice. It's a strategic foundation. Let's set the stage. Why does this currency decision matter so much today? Why is currency risk management suddenly so critical?
Well, the core context is volatility and global interconnectedness. We live in a world where central bank decisions in Washington or Frankfurt or a geopolitical event in Eastern Europe have an instant, direct impact on your purchasing power. If all your investments are denominated in a single currency, say the dollar, you are essentially a passive spectator. You're letting external forces, inflation, faraway interest rate decisions, dictate the real value of your future wealth.
Right. So you might nail the stock pick but lose 10% because your base currency depreciated against the currency of the asset you bought. That must be frustrating.
Exactly. And that frustration is poor currency risk management. We need to stop thinking of currency as just a conversion tool and start seeing it as an active layer of risk, or better yet, a layer of protection.
Let's dive into the core discussion, starting with the US dollar, the undisputed heavyweight champion. What makes the USD the global reserve currency, and what does that mean for an individual investor?
The US dollar, as you said, is the captain of the financial ship. Its dominance isn't accidental. It's built on extreme liquidity and historical confidence. For the investor, extreme liquidity is the number one advantage.
Meaning you can always buy or sell no matter what?
Precisely. No matter where you are, no matter the time of day, there's always a market ready to accept or exchange dollars. This is crucial because it minimizes the risk of your assets ever becoming frozen or illiquid. But the deeper phenomenon is what we call the flight to quality.
Ah, the safe haven effect.
That's it. When global panic hits, think 2008, think 2020, capital doesn't mess around. It instantly rushes to the USD, especially US Treasury bonds. By owning dollar-denominated assets, you're indirectly buying insurance against global geopolitical or economic crises.
That institutional strength, the sheer size and depth of the U.S. market, is also directly linked to the Federal Reserve, the Fed. How do their decisions impact the foreign investor?
The Fed's decisions ripple globally. When the Fed raises the federal funds rate, it doesn't just affect mortgages in California. It makes dollar-denominated assets, like treasuries, significantly more attractive globally. This, by definition, strengthens the dollar. The institutional strength of the Fed, its dual mandate of maximum employment and price stability, is what you are fundamentally betting on when you invest in the USD.
So, in essence, the dollar gives you access to the safest asset on the planet, the U.S. Treasury, and the most innovative assets, like the S&P 500 and the NASDAQ.
That's the core thesis for the USD portion of your portfolio: liquidity, safety, and access to the heart of global innovation.
Now, let's pivot to the euro. If the dollar is the captain, you describe the euro as a well-constructed brick house. What does that mean structurally for investors looking outside the U.S.?
The euro is a younger currency, but it represents the combined industrial might of 20 advanced economies. It's the world's second most important reserve currency, and its strength is its intrinsic risk diversification.
Intrinsic diversification. I like that term. Can you explain that with an example?
Certainly. Imagine a single country in the Eurozone, say a smaller economy, faces a temporary financial crisis, as we saw with Greece around 2010. While that was a severe event, the overall turmoil is mitigated by the sheer weight and stability of the larger economies like Germany, France, and the Netherlands. The Eurozone acts like a built-in shock absorber for the international investor, preventing turmoil in one area from dominating the currency's value.
That's a good counterweight to U.S.-specific risk. What about the European Central Bank, the BCE? They operate differently from the Fed.
They do. The BCE, led by Christine Lagarde, has the primary mandate of maintaining price stability, keeping inflation around 2%. But their main structural hurdle is coordination. They must set a single monetary policy for 20 highly diverse countries with different economic needs.
That's an impossible job, really.
It is. And this often leads to a policy divergence from the Fed. For example, if the U.S. economy is booming and the Fed is cutting rates to balance growth, the BCE might be more cautious or slower to cut rates to stimulate a more moderately growing Eurozone. That divergence is gold for currency investors. A slower, more cautious BCE can paradoxically strengthen the EUR in the short term because the relative interest rates in the Eurozone become more attractive than those in the US.
So where does the euro provide superior opportunities?
It's the perfect counterweight to overexposure to the US. The Eurozone offers value-oriented equities, companies in engineering, luxury goods, and automotive that are world-class exporters, but often trade at lower valuations than their growth-focused U.S. counterparts. Plus, the European corporate debt market is massive, offering high-quality bonds that balance risk and return beautifully.
So we have the dollar, the safe haven and growth engine, and the euro, the diversification and value pillar. How do these two dance together, particularly when influenced by things like energy and geopolitics?
This is where the dynamic really gets interesting. The relationship is a continuous dance, often dictated by commodity prices and, critically, the interest rate differential between the Fed and the ECB. The smartest way to manage currency risk, as we mentioned, is global diversification.
The golden rule, right?
Absolutely, because the dollar and the euro often move in opposite directions. When fear is high and the market is running for cover, the USD rises. When the market is calm and ready to take on risk, the EUR, which is closely tied to global trade, often gains ground.
What's the emotional implication of investing only in dollars when, say, the U.S. economy hits a tough patch and the Fed has to adopt a dovish or accommodative policy?
The emotional risk is losing on two fronts. Your domestic market is performing poorly and your currency is weakening. That's a tough double hit. Diversification is truly the only free lunch in finance. It buys you a natural insurance policy against that kind of volatility.
Let's touch on energy. That seems to be a huge factor for the euro.
It is an Achilles heel. The Eurozone is a net energy importer. So a spike in natural gas or oil prices, like we saw after the 2022 crisis, typically weakens the EUR and fuels inflation, while simultaneously strengthening the USD because the dollar is where commodities are priced, the petrodollar system.
I recall the EUR-USD parity hitting near 1-to-1 then. That case study vividly shows the euro's vulnerability to energy shocks versus the dollar's refuge status.
It's the clearest example. So the practical takeaway here is that you need to monitor these factors. If you anticipate rising geopolitical tension or surging energy prices, the USD offers better short-term shelter. If you foresee energy stabilization and a European export rebound, the EUR offers superior relative value.
We've covered the technicals, but let's shift to the psychological side, what you call the EEAT framework: experience, expertise, authority, and trustworthiness, as applied to the investor. How does mindset play into this currency choice?
That's where the money is really made, in your head. Experience isn't just surviving one bull run, it's surviving a complete cycle. It's asking yourself, how did I react when the market dropped 30%? Did I panic sell or did I buy more? That practical experience defines your true risk tolerance.
That's a profound self-reflection. And expertise.
Expertise means moving beyond the headlines. To manage USD versus EUR confidently, your expertise is demonstrated by understanding, for instance, the sheer size of the Fed's balance sheet, the ECB's inflation projections, and the debt-to-GDP ratios of both blocks. It's about knowing why you're making the decision, not just what the decision is.
I love that. A written plan stops you from reacting emotionally.
Precisely. And trustworthiness is security and transparency. Are your assets held in regulated brokerages? Do you understand the products 100%? If you can't explain your investment to a 10-year-old, it's too complex, and it undermines your own confidence.
Let's get ultra practical for our listeners. Based on your expert framework, what is the actionable takeaway? What's the recommended allocation strategy between the USD and the EUR for an international portfolio?
The conclusion is not USD or EUR, it is USD and EUR. The most prudent strategy is one that strategically uses the strength of each block as a necessary counterweight to the other.
So, give us the numbers.
I generally recommend a professional grade strategy